Welcome back to the Supply and Demand Pro Trader series. Some of you might be thinking, welcome back yourself. Right, it took me a while, but as soon as I saw how much this series meant to you, I caved. You know how much I love talking about supply and demand, and you know how much I love sharing my knowledge with you. I thought from day one of this channel that these lessons from my supply and demand course are valuable for every trader out there. They should be like pamphlets handed to people on the streets, because 90% of what you watch online are misconceptions about trading. There's a ton of untested theories and unproven methods out there. Supply and demand is tested and proven since the very first days of the market. Yes, even before the price charts themselves. And I believe that everyone who watched this entire series understands the market better than at least 70% of retail traders out there. Because now you understand how to trade like institutional traders do. And that reminds me, do you remember what fractals are? I hope you do, because they are the basis of today's lesson. We talked about fractals in the trend direction video, but let me go over this topic again really quick. Fractals are the directions on the higher time frame, like the daily, weekly, or monthly time frames. So what do we see here? Uptrend, sideways trend, then downtrend. So it's a classic bell curve. Those are the three types of directions that we can see on a price chart. What you see here is the big picture. But what if we zoom inside one of these zones? Let's look at the lower time frame, say the 240-minute chart, for example, also known as the 4-hour chart. What do we have here? Formations: rally, base, rally, and drop, base, rally. These are what made the uptrend happen. This gives us many high, low, and in equilibrium locations. Each has its own set of rules. We will discuss these locations today and how to trade each one of them. Alright, let's take a look at our agenda. First, we're going to take a look at the actions based on high and very high locations in combination with the different trends. Then we're going to look at the low and very low location in combination with our three different trends. And after that, we are also going to talk about what we are going to do if price is in equilibrium. Lastly, we're going to put all of that together and create our action matrix, which is going to tell us what kind of action we should take if price is either high, low, or in equilibrium, combined with the different uptrends, downtrends, and sideways trends. Alright, let's get started. This graphic may appear complex at first glance, but it's actually quite straightforward. Think of it as a decision process moving from left to right, starting with step 1, identifying the higher time frame location, followed by step 2, assessing the trend direction, and step 3, performing the lower time frame zoning process to establish our setup. That's why we call it a top-down approach. This graphic answers the question of what action to take based on the location of our LTF supply zones. For example, if our LTF supply zone is positioned high or very high on the chart in relation to the HTF, and the HTF direction is in an uptrend, then our profit margin would be low, as we would essentially be trading against the trend in a supply zone. However, if the HTF is in a sideways trend and the zone is positioned high on the HTF, the profit potential improves to a medium level compared to the counter trend scenario, though it's still only moderate. On the other hand, if we are in a downtrend and our LTF zone is positioned high or very high, this setup provides the highest profit potential among the three scenarios. As for the probability of success, trading with the trend in a downtrend yields the highest probability. Trading in a sideways trend offers a medium probability, and counter trend trades, such as trading supply in an uptrend, present the lowest probability of success. Now, all of this seems very rule-based and rigid. I know, but it will make more sense once we start looking at the chart. Let's walk through the actions we should take when price is at a high or very high location, combined with different trend directions. Understanding this in context is essential before applying it to the charts. Here, you can see the 3 steps in multi-time frame analysis. For this example, let's assume we've completed our analysis and made these observations. Observation 1. Current price location on HTF. The price is situated high or very high in terms of the higher time frame. Observation 2. Trend direction. Using our objective analysis tools, we have identified an uptrend on the HTF. Observation 3. Lower time frame LTF supply zone. We have found an LTF supply zone positioned high on the chart within the context of an uptrend. With these findings, the next step is to evaluate both the profit margin and the probability of success for setting this lower time frame zone. In this scenario, although we are positioned high on the chart, we are essentially in a counter trend trade, meaning we are trading against the primary trend. Because of this, our profit margin would be limited or low, and our probability of success would also be low. Remember, in this setup, we are trading the weaker correction move rather than the stronger momentum move. If we were trading with the trend, for example, trading in alignment with an impulse move in the uptrend, we would likely have a higher profit margin and a greater probability of success due to the momentum supporting our trade direction. In the second scenario, the only thing that changes is the direction of price. Now we have just identified a lower time frame supply zone, which is in context of higher time frame sideways trend and higher time frame location high. If we were to set this trade, we would understand that the profit margin is medium, slightly better than the counter trend trade, but still not the best case scenario. Also, the probability of success is slightly higher than the counter trend trade, but again, there's one scenario that would even offer a better probability of success. This is the best case scenario in terms of higher time frame context, or in other words, big picture. Let us say we identified a lower time frame supply zone in the context of a downtrend and in a context of location high. Setting this trade would offer the ideal profit margin scenario and the ideal probability of success scenario. Trading lower time frame supply in the context of higher time frame location high and higher time frame downtrending markets. Now, let's address what actions to take when our lower time frame LTF demand zones are located low or very low on the chart, depending on the higher time frame HTF trend direction. Uptrend on HTF. If our demand zone is positioned low on the HTF and the HTF is in an uptrend, this setup offers an ideal profit margin. This is because we are aligning with the primary trend by trading within a demand zone in an uptrend. A price is more likely to rise from this low point. As a result, both the profit potential and probability of success are high. Sideways trend on HTF. If the price is trending sideways on the HTF, and we identified an LTF demand zone positioned low or very low, our profit potential is moderate. While we are not fully aligned with the trending market, the low demand zone could still provide a decent opportunity, though with a medium probability of success. Downtrend on HTF. In the case of a downtrend on the HTF, an LTF demand zone located low or very low on the chart would present the lowest profit potential. Here, we would be trading against the primary trend, which means the probability of a successful trade would also be the lowest. In summary, trading demand zone with an uptrend offers the highest potential of probability, a sideways trend offers a medium potential, and trading against a downtrend provides the lowest opportunity. This framework is crucial for understanding how to position ourselves within the broader market context. Let us again put this in a visual context. Let's assume we've just done the analysis and these are our findings. Current price is located low or very low in terms of HTF location. We also identified an uptrend using our objective direction analysis tools. And we found a lower time frame demand zone, which is in the context of HTF low and in the context of an uptrend. We now wanted to set the lower time frame demand zone. We would need to understand, first of all, our profit margin, and secondly, our probability of success. Setting this trade would offer the ideal profit margin scenario and the ideal probability of success scenario. Trading lower time frame demand in context of higher time frame location low and higher time frame uptrending markets. In the second scenario, the only thing that changes is the direction or trend of price. Now we have just identified a lower time frame demand zone, which is in context of higher time frame sideways trend and higher time frame location low. If we were to set this trade, we would understand that the profit margin is medium, slightly better than a counter trend trade, but still not the best case scenario. Also, the probability of success is slightly higher than the counter trend trade, but again, not as good as the trend trade. This is the worst case scenario in terms of higher time frame context, or in other words, big picture. Let us say we identified a lower time frame demand zone in the context of a downtrend and in the context of location low. Setting this trade would offer the minimal or low profit margin and low probability of success. Counter trend, whether it is trading supply with an uptrend or demand with a downtrend, offers the worst HTF context. The best HTF context are always trend trade, trading demand with an uptrend and supply with a downtrend. This is our final stop before we consolidate all the strategies into one summary. Here we are examining what actions to take when our lower time frame LTF zones, whether demand or supply, are positioned in equilibrium on the higher time frame HTF location. Uptrend on HTF. If an LTF zone is situated in equilibrium on the HTF and the HTF is in an uptrend, our profit margin would be medium. This setup allows us to trade a demand or supply zone with the trend, but it doesn't have the same potential as a zone positioned at an extreme on the HTF. In a strong uptrend, prices may not return to these extreme zones, so trading within the equilibrium zone provides an opportunity, though with a slightly reduced profit margin and probability. Sideways trend on HTF. If the HTF is moving sideways and our LTF zone is positioned in equilibrium, this setup doesn't offer a viable trade scenario. The sideways trend combined with the equilibrium location results in insufficient profit margin and probability, making trading in this context inadvisable. Downtrend on HTF. Similar to the uptrend scenario, if the HTF is in a downtrend and our LTF supply zone is positioned in equilibrium, we can trade the LTF zone with the trend. Although the profit margin and probability are lower than trading at an extreme zone, it is still reasonable if the downtrend is strong enough. In summary, trading from an equilibrium location is permissible when aligned with a strong uptrend or downtrend, even though the potential profit margin is moderate. However, equilibrium locations within a sideways trend do not offer sufficient opportunity and should be avoided. This framework allows us to consider equilibrium zones in a strong trending market, ensuring we can still participate in the trend even if the price isn't at an extreme. Let's assume we've just done the analysis and these are our findings. Current price is located in equilibrium in terms of HTF location. We also identified an uptrend using our objective direction analysis tools. And we found a lower time frame demand zone, which is in the context of HTF equilibrium and in the context of an uptrend. If we now wanted to set the lower time frame demand zone, we would need to understand first of all our profit margin, and secondly, our probability of success. Setting this trade would offer medium profit margin and medium probability of success scenario. In the second scenario, the only thing that changes is the direction of price. And this is an important point. If lower time frame zones are located in a context of bigger picture equilibrium and sideways trend, we are not allowed to set the trade because this would be a low probability, low profitability trade setup. And our goal as a trader is to find high probability and high profitability trade setups. This is the last example. Let us say we identified a lower time frame supply zone in the context of a downtrend and in the context of HTF equilibrium. If we now wanted to set the lower time frame supply zone, we would need to understand first of all our profit margin and secondly our probability of success. Setting this trade would offer medium profit margin and medium probability of success scenario. So the key takeaway here is that trading in equilibrium is allowed, but not ideal if we are trading with the trend. Let's sum up our findings with the action matrix. You can take a screenshot and print this out. Keep it on your desk or on your desktop. This action matrix is going to guide you as it combines location, direction, and the lower timeframe zoning. Let us start with LTF demand. We are always allowed to trade lower timeframe demand if we are in the context of HTF low and very low. But the profit margin and probability of success changes depending on the trends we identified. The best case scenario is trading with a trend, in this case an uptrend, where you could also buy in the context of equilibrium with slightly less probability and less profitability. The medium scenario is trading demand in the context of a sideways trend, and the worst scenario is trading demand in the context of a downtrend. We can never trade demand in the context of higher timeframe location high. Now, let's talk about LTF supply on the right side. We are always allowed to trade lower timeframe supply if we are in the context of HTF high and very high. But the profit margin and probability of success changes depending on the trends we identified. The best case scenario is trading with a trend, in this case a downtrend, where you could also sell in the context of equilibrium with slightly less probability and less profitability. The medium scenario is trading supply in the context of a sideways trend, and the worst scenario is trading supply zone in the context of an uptrend. We can never trade supply in the context of higher timeframe location low, even if we are trading with the trend. Alright, there you have it. At this point in our supply and demand series, you should have a full understanding of location and direction analysis. That was everything for today, folks. I hope you enjoyed the lesson. Your likes and comments always make my day. Happy and safe trading.